Good afternoon, everyone. I hope I'm audible. Can somebody just say if I'm audible or not? Hello? Is it audible?
Yes, audible.
Yes, ma'am.
Okay, thank you. Good afternoon again and namaste and greetings from my National Institute of Abiotic Stress Management, Varanasi, and hope you all are doing well. And I, Elisa Pradhan, welcome you all to the second session of this training program, which will be on accounting, concepts and convention. And our speaker for today's section is Dr. Sunil Kumar Das. By now, you all must be knowing him because he's the course director of this training program has taken so many virtual training sessions before also. But I would take this opportunity to introduce him as a speaker for today's session. So Dr. Sunil Kumar Das, he is a PhD in Commerce from Utkal University and Odisha and now being posted as Chief Finance and Accounts Officer at ICAR National Institute of Abiotic Stress Management, Pune. He has worked as co-principal investigator in 5 number of research projects and conducted 80 training sessions as well as 13 national level training programs in the area of actual accounting, pension and retirement benefits, national pension system, GFR, GST, PFMS, entrepreneurship development program, startup agribusiness incubation program, preventive vigilance, and many other topics related to integrity, a way of life, being human, stress management, eternal cleansing, a way of happiness, etc. For this, he has also been awarded with ICAR Cash Award Scheme 2018 for the administrative category, which is decorated for the excellent work in the administrative and finance field of ICAR. He's also been awarded and certified as a ICAR Certified Master Trainer for the special training areas on actuarial accounting, PFN, MS, pension and retirement benefits. He has published 15 research papers and 5 technical bulletins on SFGs, FPOs, IFS, banking and finance, etc. And also authored 2 books, one on resource book on accrual accounting for administrative and finance personnel, and another on new training modules for administrative and finance staff of ICAR. With this brief introduction, I now invite Dr. Sunil Kumar Das, sir, for his talk today. So please.
Namaskar. Very good afternoon to all of you. My dear friends and colleagues, as you know, today is the second session of this pre-examination training for limited departmental audit and accounts examination for the post of AFO in ICAR. We have planned 50 online sessions during this 2-3 months period of time, and this is the second session only. As I have told earlier, around 30 resource persons will be engaged, will be involved during this training process, and almost all the resource persons are the stalwarts, subject matter specialists of the ICAR, other than ICAR also. As you know, for every accounting starts from concept, convention, like that only. If you talk about double entry bookkeeping system of accounting, initially the journal entry has to be prepared, then the entries have to be posted into ledger, then after ledger, balancing of the ledger has to be made, Then it has to be posted into the trial balance. Then on the basis of trial balance, trading and profit and loss account will be prepared if it is a trading concern. Manufacturing account will be prepared if it is a manufacturing concern. Income and expenditure account and receipt and payment account will be prepared if it is a non-profit making organization like ours. And finally, balance sheet will have to be prepared. So that means the entries, the accounting entries, the journal entries in the books of accounts or in the financial statements, whatever it may be, these accounts are to be prepared. The journal entry has to be passed based on certain concept, convention, principles. So that today's session we will be discussing on those aspects only. So this is the beginning of the any accounting session. Means after this session, again you may tell your bookkeeping, trial balance, trading account, profit and loss account, manufacturing account, income and expenditure account, like that. After this only, all other account will be coming into picture. Then what is the meaning of accounting? It is the process of recording financial transaction of a business. Accounting is nothing, it is just recording, classifying, summarizing transactions, and the result of which will be shared among the internal user or external user for the different purposes. If they are internal users like your employees, creditor, debtor, investor, tax authority, consumers, like that. These are the internal users, and the external users will be your government agencies, regulatory bodies, your print and electronic medias. These people, both internal or external, these people need information from any business. Information in the sense of financial aspect, that is directly or indirectly required for the betterment of the society, you can also tell. According to American Institute of Certified Public Accountants, accounting is the art of recording, classifying, and summarizing transactions and events in a significant manner and in terms of money, and in part at least of a financial character, and interpreting the result thereof. What I told you that, first of all, the transactions has to be taken place in the books of accounts, and those transactions has to be made in terms of financial, monetary terms. Means if money will be involved, then only it will be termed as a financial transactions. If there is no money, simply giving and taking or exchange, like a barter system earlier, so that will not be treated as a transactions. For any buying or selling, for any purchasing, some amount should be involved. Somebody has to pay something, somebody has to receive something, be it on cash, be it on credit. Amount involvement should be there. If the transaction has not been expressed in terms of money, or if there is no monetary value involved in the transactions, that transactions cannot be defined as a financial transactions. So that is why those type of transactions will not be taken, will not be recorded in our books of accounts. What are the features, characteristics of accounting? The first is recording of financial transactions. Whenever a particular transaction takes place, we have to, we being the accountant, being the account officer, being the people working in the accounts division, we have to keep a record on those transactions. The record may be by way of passing journal entries, or maybe by way of writing somewhere, maybe some organization they are making entries by way of tally like that. Then after the recording of the financial transactions, the transactions has to be classified. Classified in the sense it has to be posted into the respective ledger. Respective ledger means if two accounts are involved. For example, if I have purchased one laptop worth rupees 1 lakh by paying cash, so obviously there are two accounts involved in this. One is laptop account that I have purchased, and that laptop has come into our office, institute. And other account involved is, for that we have paid 1 lakh rupees. And that 1 lakh rupees has gone out of from our business, our institute. So that is why these two accounts are involved. So these two accounts means that money, 1 lakh rupees, it has to be recorded in laptop account also, in cash account also. So likewise, classification has to be taken place, and in that classification, we will be able to know whether the expenditure incurred is of revenue nature or is of capital nature. Then question comes, what is revenue expenditure and what is capital expenditure? Is a very fundamental. We all are knowing recurring expenditure, non-recurring expenditure. And in the present context, we are receiving grant in two forms: grant in net capital, we are receiving grant in net general, we are receiving grant in net salary also, we are receiving. These under three heads, we are receiving grants. So one is capital and other one is revenue. Revenue means recurring nature, any expenditure made towards routine duties like your payment of electricity, payment of wages, payment of salary, payment of postage, payment of fuel, like such type of things. These will be of revenue expenditure. Then what is capital expenditure? Now any expenditure incurred for creating an assets, the life of which will be for more than 1 year, means we will be getting benefit out of that assets, out of that item for years together. For example, again come to that example, laptop. If we have purchased laptop, so that laptop will be in use maybe for 4 years, 5 years, 3 years. Certainly it is more than 1 year. So that is why laptop expenditure incurred on purchase of laptop is a capital expenditure. Whereas expenditure incurred on account of payment of salary, payment of rent, payment of electricity is a revenue expenditure. Why? Now the basic concept, basic objective is that the very nature of expenditure suggests that the benefit will be expired. The benefit out of the payment on account of that revenue expenditure will be expired a very short period of time. Means within a month it will be expired. That means if we are paying electricity bill for the month of January, then in the month of February, again second bill will come. The first bill, that benefit will be expired in the month of January itself. But if it is a expenditure of capital nature, like purchase of computer, purchase of furniture, construction of buildings, construction of road, like that, that benefits will go for years together. Means it is not like that. We will be using laptop or computer, our building for 6 months, for 1 year, like that. It is there. Will be that assets will be also generating revenue income for us in future. Then after recording, then after classification, then summarization of the transactions takes place. Summarization means whatever transactions are recorded and classified, it has to be posted in the ledger and summarized there. Summarize in the ledger, balancing has to be made, means the debit side of the particular ledger and credit side of the particular ledger has to be tallied. And the difference means balance brought down or balance carried down. That balance will go to the trial balance. Then every point of time, the debit side of the trial balance will tally with that of the credit side of the trial balance. That means if we have made certain journal entry in our books of accounts, if we have made journal entry, if we have posted into ledger and we have posted into trial balance also, if our trial balance is not matching, means debit side does not match with that of credit side, in that case, it is assumed that certain somewhere we have committed some mistake. That is why the debit of the total is not telling with that of the credit of the total. So that means what I mean to say is that at every point of time, the trial balance, debit side and credit side will match. If it doesn't match, that means we have committed some error somewhere. Then on the basis of trial balance, next maybe your trading account will be prepared, profit and loss account will be prepared, and accordingly balance sheet also will have to be prepared. Then accounting next comes, every transactions has to be measured in terms of money. There should be monetary value involved in this. Then only it can be recorded in our books of account. If there is no money, then what will write in our books of account? We cannot write anything in our books of account. Means it will only we can write. For example, if we have purchased furniture, for example, 100 numbers of chair we have purchased, and monetary involvement we do not know. We do not know the cost of the chair. Then in our books of account, what will write? We cannot write only we have purchased 100 numbers of chair. It has to be there should be some value, and that value has to be reflected in our books of account. Finally, that value has to be placed in the balance sheet of our institute. Then transactions and events, all these recording, classification, summarization, it all relates to the transactions or events. That means, first of all, the events has to be taken place. The transactions has to be taken place, be it be inside the organization or be it be outside the organization. If it is involved in the inside things means it will be maybe we are charging depreciation, like it is a non-cash transaction. Depreciation means for this we are not paying any cash depreciation, loss of fire. It is inside the organization. These things happen inside, within the institute, within the organization. And if some examples outside the organization means if you are paying certain amount on the basis of certain means after receiving of something, maybe again some items we have purchased. On receiving of that item, we are paying, and we are paying salary, we are paying rent. That also involves to payment to outsiders, not within outside in the sense outside. You see here payment of salary is written. So anybody may raise the questions. Once you are paying payment of salary, then why it is the question of outsider? Salary is a payment very well to the staff of the organization. Then why outsider? That is why outsider. Here employee and the business are treated as two different entities. Business, our institute, our organization is one, is separate from us. That is why if pattern salary is paid to us, it will be treated as the institute as payment to an outside agency. Then interpretation of results. All these results has to be interpreted. Means some ratio analysis has to be made, some your cash flow analysis, fund flow analysis. So many things has to be prepared on this basis of the trial balance or profit and loss account or a trading and loss account. Then you see these are the accounting cycle. These are the accounting cycle involved in a particular transaction. First one is transaction. The top one is transaction. After happening of the transaction, journal entry has to be taken place. Next is journal. Then after journal, ledger has to be prepared. After ledger, trial balance has to be prepared. Then trading account is to be prepared if it is a trading organization, and profit and loss account is prepared. Then finally, balance sheet is prepared. You see, all this aspect, trial balance is prepared to know the arithmetical accuracy of the firm, arithmetical accuracy of the transactions. Whatever transactions we have made, if the debit side tally with that of the credit side, that means our transactions are perfectly okay. Then trading account is prepared to know the profit, gross profit of the enterprise is to be known by preparing the trading account. And profit and loss account is prepared to know the net profit of the organization. And balance sheet is prepared to know the financial position of the organization on a particular date. What is the total assets of the organization? What is the total liabilities of that organization? That can be known upon preparing the balance sheet only. And balance sheet is prepared on a particular date. Whereas your profit and loss account, trading account, it is prepared for the whole year. That is why narration we used to write trading account or profit and loss account of Messrs. ABC Company Limited for the year ending 31st March 2023. We are writing generally profit and loss account of Messrs. ABC Limited for the year ended 31st March 2023. But so as regards balance sheet, it is written that balance sheet of Messrs. ABC Company Limited as on 31st March. Balance sheet is prepared on a particular date, whereas trading account, profit and loss account is prepared for the whole year. Then you see journal ledger in between journal and ledger, this your books of original entry also are available. What are the books of original entries? That means there are 8 books. If we are making any cash transaction, any cash, whether it be cash receipt or cash payment, it will be recorded in the cash book. If we are purchasing goods, what is goods? Question comes, what is goods? In commerce terms, accounting terms, goods means the business has been set up for a particular purpose. Any institute, any organization has been set up for a particular purpose. If that the items dealt by that firm is known as goods for that. Means if any firm is purchasing and selling car, for example, motor car. So car will be treated as a goods for them. If any company is purchasing and selling bicycle, so bicycle will be treated as goods for that company. So likewise, your goods will be like any item dealt by that business firm. So any purchase of goods on credit is treated as purchase book. Okay. Purchase of goods on credit will be purchase book, will be recorded in the purchase book, and sale of goods on credit basis will be recorded in the sales book. And purchase of goods on credit and subsequently returned, it will be recorded in the purchase return book. Likewise, sale of goods on credit and subsequently returned, it will be recorded in the sales return book. And one is bills receivable. Bills receivable means it is a credit transaction, no doubt, but we have received certain bills, means promissory note, bill of exchange, like that. So that will be recorded in the bills receivable book, and other one will be recorded in the bills payable book. If something is to be paid from our side, and if we have promised, if we have given something, it will be recorded in the bills payable book. And finally, any transaction having no place, starting from cash book to bills payable book, from 1 to 7, if any particular transaction has got no place, then it will be recorded in the journal proper book. So likewise, these are the books of original entry. Cash book is only cash transactions will be recorded. Maybe receipt of cash or payment of cash. Only cash transactions will be recorded in the cash book. Purchase book, purchase of goods on credit, if it is made, it will be recorded in the purchase book. sale of goods on credit, if it is made, it will be recorded in the sales book. Purchase return, purchase of goods on credit and subsequently returned by us. Maybe due to defect, maybe something not matching to our specification, like it will be recorded in the purchase return. Like if we have sold something and that person has returned that goods to us, it will be recorded in the sales book. So likewise, these accounting cycles will be there in our books of account in our business. Then what are the qualitative characteristics of accounting information? Accounting information. These are the very qualitative characteristics. One is reliability. Second one is relevance, understandability, and comparability. Means accounting information I am taking means whatever accounting information, how reliable it is. That is a qualitative characteristics, features, how reliable it is. That means the information should be very much reliable, very much verifiable. Then only it has to be trusted. Then only it has to be recorded, or our books of account will give a very fair and true value, a true picture of the business. Then relevance. Relevance means whatever accounting information we are preparing, how helpful the information is in making the financial decisions. How helpful it will be, how relevant it is to us, the accounting information. If it will be relevant, so then only it will be considered. Then the accounting information, the understandability is the degree to which the information is easily understood. Means the information, if we are very quickly can understand the information, means if there will be no, you might have seen while preparing the annual account, I am talking about annual account of the private organizations. Generally, a non-profit making means a loss-making organization. Loss-making organization, maybe in their balance sheet there will be loss if it will go, but they might have shown certain words, certain terminology in a very complicated manner that the external people, the auditor like that, they will not easily understand those things. They will be using some very different phrase, some jargon words like that they will be using. So that means they knowingly they will put some difficult complexity words so that the external or the people who will go through the annual account, they will not be in a position to easily understand the report. Then finally is comparability. Comparability means the accounting transactions on record has to be prepared on the basis of the accounting standard and policy. And the accounting standard and policies are consistently applied or followed in that organization from year after to year. Then only the profit of a particular year can be compared with of a next year or a different year. Means if we are following the same policy, same guidelines for years together. For example, we are charging depreciation on straight line method. Our depreciation rate is 10%, for example. And if on this basis we are charging depreciation for 2-3 years, so then only the profit of the institute or organization can be compared from 1 year to other year. If this year we have charged depreciation at the rate of 10%, but the next year we have charged depreciation 20%. In that case, it is very difficult to charge the compare the profit of the organization. That means whatever policies, whatever accounting standards that we are following, that has to be followed consistently for years together, then only the comparability or the profit of the organization or the financial position of the organization can be compared from 1 year to others, from different years. It can be compared. Then this is one important terminology, very important terminology. Substance over form. This is substance over form. In accounting, it plays a very important role. That means what is substance and what is form. This concept refers to transactions recorded in a financial statement that reflect their economic substance rather than merely their legal form. Whatever be the legal form, that is immaterial. But what is the economic substance of that item? The substance is how a person looks at a particular object, sees a particular things, or how it appears to him. This is the substance. Whereas the form is the legal status of the subject. That is the form. One example will make you very much clear. Imagine a cake that is made to look like a sucker ball. Cake has been prepared in such a way that it is looking like a ball, sucker ball. So that means here just cake and ball you compare. In fact, the item is cake only. It is not ball. The item is cake. But we are prepared in such a way. It looks like a sucker ball. So here you can tell what is substance and what is your form. The cake form is that of a sucker ball. What? The substance is, however, a cake. Means it is in fact a cake. Means what is the real? The real things. The real things is the cake. It is the substance. But it looks in form of cake. Means it looks like cake. Though it looks like cake, it is one example only. But the substance over form is a very important while any accounting entries or transactions, it is very much we should know. Then accounting principles. Accounting principles are guidelines to establish standards for sound accounting practices and procedure in reporting the financial status and periodic performance of a business. These standards are policy document issued by government or any professional institute or professional bodies like our Institute of Chartered Accountant of India, Institute of Cost Accountant of India, like that. So that means the principle means on the basis of certain standards, on the basis of certain guidelines, we used to prepare the your various transactions, or we used to pass various entries in our books of accounts. That is accounting principle. Generally accepted accounting principle, GAAP. What is GAAP? This generally accepted accounting principle is a technical accounting term that encompasses the convention, assumption, concept, rules and procedures necessary to define accepted accounting practice at a particular point of time. That means it is nothing. GAAP is nothing. It includes the concept, the convention, the rules, the provisions, procedures on the basis of which the accounting entries are made. Means what I mean to tell is that whenever we are passing any entries on the happening of any events or transactions, it has to be passed based on certain principles, certain guidelines, certain policies. So these principle, guidelines, policies, these are not scientifically proved also. These policies have not been proved out of experiment also. These all are man-made. This policy, principle or convention also varies from person to person. If you are following, for example, if we have decided that we will be charging depreciation at the rate of 20% for computer, for all the computer we have purchased for our institute, depreciation will be charged at the rate of 20%. We have charged depreciation for 4 years, 5 years. Afterwards, we can see whether depreciation will be charged at the rate of 20% or 10% or 15%. So like that, if that will be changed means again our something, our guidelines, certain assumptions have been changed. Then GAP includes not only broad guidelines of general application, but also detailed practices and procedures. GAP are those rules of action or conduct which are derived from experience and practice, and when they prove useful, they become accepted as principle of accounting. That means on the basis of experience, on the basis of practice, your general accepted accounting principles, they generally decided, and when it is accepted, then it becomes like principle. Then how relevant it is, the generally accepted accounting principle. It is meaningful and useful to the use of accounting information. How relevant it is? Objectivity. It is the reliability or verifiability and trustworthiness. It is objective if not affected by the personal bias. Means any information, I'm talking about information only, accounting information. Means any accountant or accounts officer involved in preparing the final account or in preparing your books of accounts, they should provide information, very real information, true information, without any bias. They should provide the information. Feasibility, it is the applicability in practice. We should follow. It can be, if it can be acceptable or it can be used in practice, then we should follow that. It can be implemented without any complexity like that. Then characteristics of accounting principle. As I told you, these are man-made. So though they do not have the authoritativeness as universal principle like the principle of physics or chemistry and other natural science. Your principle of physics and chemistry, these all are proved. But these accounting principles, these all are man-made. It can be changed from person to person, year after year. These principles are neither completely certain, such as physical and chemical science, nor can this be verified by experiment. As I told, accounting is a social science and it is the result of natural economic phenomena. It is sometimes it is termed as a social science. The science of accounting is not a finished form. It is in the process of evolution. Means every day some certain changes are being taken place. It is not a finished form. Means that means we have conducted the experiment and the result is final. Then this experiment result cannot be changed. It is not like that. It will be changed. Our accounting principle will be changed. These are influenced by business practices and customs, government agencies, and other business groups. This accounting information, it is very much influenced by the business, whatever practices we are following, whatever customs we are adopting, and what is the regulation or guidelines of the government agencies within that periphery. So our information will be also influenced to that extent. A principle is objective to the extent that the accounting information is not influenced by the personal bias of those who furnish the information. The accounting information given in the financial statement should be free from the personal bias of the person who have taken part in the preparation of the such statement. What I mean to say is that those who are involved in preparing annual account, they should provide free and biased information. A principle is feasible to the extent that it can be applied without undue complexity or cost. These principles are not only followed by one accountant, but followed by all accountants in India and world. These accounting principles, these are derived from necessity, argument, and experience, neither checked by verification nor derived by written law. As I told, these are the accounting concept. I told you first, principle, GAP, generally accounting principle, generally accepted accounting principle. This principle is divided into two parts. One is concept, accounting concept here. Afterwards, I will be coming to convention. On these basis, accounting records, accounting transactions are taken place in our books of accounts. These are the basis. So what are the accounting concepts? Accounting concepts may be considered as the basic assumptions or conditions upon which the science of accounting is based. So there are many accounting concepts like entity concept, money measurement concept, periodicity concept, accrual concept, matching concept, going concern concept, cost concept, realization concept, dual aspect concept, conservatism concept, and consistency concept. I will discuss this concept briefly. Means on the basis of this concept only, all the entries, all the events, or all the transactions are taken place in our books of account. One by one, we'll discuss what are these concepts. Means while passing any entry, journal entry or any entry in our books of account, we have to think in that way only. Then only our business will give a true picture of you, fair and true picture. Then only it can be given. If you think in this way, these are the accounting concepts. First is business entity concept. What is business entity concept? That means in business entity concept, this business and businessman are treated as two different persons. Business separate, businessman separate. Though businessman is providing money to the business as capital for the commencement of the business, but in the record, this business and businessman will be treated as two different persons. That means whenever a businessman pays money to the business, that will be termed as capital for the business, and it is the duty of the business. It is the business means that establishment, that organization. It is the duty to pay that capital back to the businessman. In the similar way, whenever businessman draws any money from the business for his personal use, for example, Mr. A is the businessman, he draws money for his personal use, that will be treated as drawings. Drawings means he draws money from the capital. Your capital balance will be reduced. Capital means the loan or your capital fund for the organization. That money will be reduced. So that is why if this entity concept says every time business and businessman are two different persons. If, for example, the businessman is paying life insurance premium for his life, for his personal life, so that is his own business, own transaction. It will be recorded separately. It will not be recorded in the books of the business. If the businessman has purchased one car, for example, one car for business use, for office use, that car will be treated as the asset of the business. At the same time, if that businessman has purchased one car for his personal use, that will be treated separately. It will not be recorded in the business transactions. So when the businessman provides money in form of capital to the business will no doubt, business will pay back the capital. At the same time, interest on capital also has to be paid. At the same time, when businessman draws money from the capital, it is termed as drawings. If businessman draws money from the capital, the businessman also has to pay interest on this only. Then this is according to this concept, only those transactions are recorded in the books of account which can be recorded in terms of money. Money measurement concept that I told you, money measurement concept, whatever be your transaction, whatever be your events, it has to be recorded in terms of money. It has to be measured in terms of money. Then only it can be recorded. Then only it has to be entered in the books of account. Otherwise, it is difficult, not difficult. It cannot be entered in the books of account. Thus, the money measurement concept of accounting has two major limitations. What is that? It restricts the scope of accounting because it is not capable of recording transaction which cannot be expressed in terms of money. What it means that, for example, if your strike, agitation done by our employees or certain worker, in that particular day, our business entire production hampers. The business, the production unit not in a position to produce anything for a particular one day strike. So whether can you be able to express in terms of money what is the total amount of that unit we have not produced? Yeah, that day we are not in a position to produce those amount. Can it be expressed in terms of money? In that way, this money measurement concept has certain limitation. It does not take care of the effects of inflation because it assumes the stability of the money measurement unit. Inflation in this case also. There is a limitation for money measurement concept. Going concern concept means we have to think that every time, whenever we put any money for commencement of any business, the business or establishment gets started, and we have to think that it will go forever. It is not that we should not think that no, it is for 1 year or 2 year or 3 years like that. No, it will go forever. Thinking that we have to record our transaction. That is why we enter our fixed assets in our books of accounts by charging depreciation, which we used to charge depreciation on our fixed assets. Why depreciation? What is depreciation? Depreciation on separate chapter is there. There we will discuss. But still, depreciation means if a particular use of asset, if we are using that particular assets for years together, the value of that assets will be reduced. Definitely. So that is that is known as depreciation. Year and year, by using a particular assets, that value gets reduced. So that will be depreciation. So depreciation means if we have purchased laptop of rupees 1 lakh for this year. Next year, this year we have shown it in our books of account as 1 lakh. But in the next year, that laptop will not be shown in our books of account as 1 lakh because their depreciation has to be charged maybe 10% or maybe 20%, depending upon the policy of our of your organization. If depreciation is 10%, 10% of 1 lakh means 10,000 will be the depreciated amount, depreciated value. Then net depreciated value means your value of the laptop for the next year will be 1 lakh minus 10, 90,000 will be shown in your books of account. So likewise, it will go for 10th year. In the 10th year, it will be 0 like that. So considering this going concern concept, thinking that our business will go forever, we used to charge depreciation on our fixed assets. Otherwise, there is no point of charging depreciation. Again, the following are the cases where going concern concept is also not valid. These are the cases when this concept is not valid. What are the cases? When an enterprise was set up for a particular purpose and which has been achieved or to be achieved shortly. If for a particular purpose one enterprise has been set up, then that enterprise has to be closed immediately after fulfillment of that objective. So for that, in that case, this going concern concept will not apply. When a company is declared sick, when the company is declared sick by the Board of Industrial and Financial Reconstruction, VIFR, then in that case also this going concern means, okay, it might have thought that the company will go forever, but after 1 year or 2 years, that company has been declared as a sick by the Board of Industrial and Financial Reconstruction. In that case, the going concern concept also will not apply. Then when an enterprise has been set up in the grip of several severe financial crisis and is expected to wind up shortly, in that means, say for your bankruptcy is there, that enterprise huge loss has been happened, has been occurred for that enterprise. So in that case, also going concern concept will not apply. When a liquidator has been appointed in case of liquidation of the company, in that case also going concern will not apply. Then cost concept. Then it is the cost means you come to that depreciation part. Cost concept means our assets. The cost becomes the basis for subsequent accounting treatment. The cost of an asset is systematically reduced from year to year by charging depreciation. What cost concept says? For example, we have purchased again laptop 1 lakh. After completion of 1 year, if we charge depreciation at the rate of 10%, the value of laptop will be, cost price of that laptop will be 1 lakh minus 10, 90,000. Okay. 90,000 has to be recorded in our books of account. But in that point of time, if that particular laptop cost 1,50,000 in the market, for example, if that particular asset, if you will go on purchasing that asset, it will cost 1,50,000. So whether we will record 1,50,000 in our books of account or 90,000 in our books of account, obviously we will record 90,000 in our books of accounts only. That 1,50,000 market value has got no relevance for us. That is why the assets will have to be recorded at the historical cost, at the book value. Book value means cost less depreciation. In that way only asset has to be entered in our books of entry. Dual aspect concepts. We have to think that at every point of time, if there is a debit, there will be a credit. Means debit will equal to credit. At every point of time, our debit balance will equal to credit balance. If we pass a journal entry, the total amount will be equal. It is not like that. Our debit side will be 1,000 and credit side will be 800. No. Credit side will be 1,200. It is not like that. Debit and credit will be equal. And from this dual aspect concept only, this accounting equation has been derived. Assets is equal to liability plus capital. If you are talking about balance sheet, in our balance sheet, one is asset side, your right side is asset side, left side is liability side. And in that liability side, capital also is there. Capital fund is also available in the liability side. So capital fund plus outstanding total liability, if any loans or any bank overdraft, like that. Putting together capital plus liability, total will be our asset. So as per this principle, every transaction has two aspects. Every transaction affects at least two accounts. One account is to be debited and other account is to be credited. Journal entry cannot be passed with debit entry only or with credit entry only. That there has to be debit entry at the same time credit entry. Accounting period concept. What is that accounting period concept? As for this concept, we used to prepare our annual account for a particular year. For financial year wise, we are preparing our annual account. The last year was from 1st April 2022 to 31st March 2023. This was our financial year. So why annual account is preparing on this basis? Now this is as per only accounting period concept. As per this concept only, we are preparing. What is the objective behind this? Why we should prepare annual account in every year? The objective is that it is not that the businessman or the owner of the enterprise cannot wait up to an indefinite period to know the assets, know the liability, know the profit, know the liability, know the loss of the organization. He will not have to wait for the indefinite period. The profit has to be calculated, the loss has to be derived, immediately, maybe after a 1 year. So that is why the accounting period concept has come into picture. As per Companies Act, the accounting year will be from 1st April to 31st March. So that is why every time we are preparing our annual account from 1st April 2000, April of a particular year to 31st March of the next year. This accounting year is 1st April 2020 to 2023, and it will go up to 31st March 2024. Then matching concept. What is matching concept? According to this principle, for determining the profit made by the business during a period, revenue of that period should be matched with the cost, means expenses. Thus, profit is ascertained by deducting expenses from revenue. Means matching concept, how it goes, whatever you are incurring expenditures, if you are incurring expenditure, if certain amount, in that you must be getting something. It is not like that simply you have paid 1 lakh for purchase of laptop, you have paid 1 lakh. At the same time, you have brought laptop for the organization only, you have paid salary, and you have availed the service of the accounts officer, the administrative officer. That means your cost and expenses has to be matched. Revenue and your expenditure has to be matched. Means first of all, revenue means income. What is the income of your organization? Expenditure means this expenditure has to be again incurred out of the revenue only, out of your profit only. Then if your revenue is more, expenditure is less, there will be profit. But if your expenditure is more, revenue is less, there will be loss. This is some actual concept. As per this, as I told you, matching concept, that is why this point also need to be clarified. What is outstanding expenses? What is outstanding expenses? Outstanding expenses means any expenses due but not paid, that is treated as outstanding expenses. You take the example of, again, salary for the month of March. For us, for every institute, salary for the month of March is not paid by 31st March. It is not paid. It is paid in the first week of April. Then that salary of particular March is the outstanding expenses. Means though it is not paid within 31st March, but it is the expenses of that particular year, even though it is not paid. Even though it is not paid, but we have incurred the expenditure. Means if the employees have been engaged up to 31st March, we have incurred the expenditure even though it is not paid. So that is why that salary for the month of March will be treated as outstanding expenses. How it is treated in the annual account? How it is treated? For example, that March month salary is 2 lakh for any enterprise. It is 2 lakh. That 2 lakh will be added to the entire year salary expenditure. Maybe for up to 11 months, you may be having salary expenditure. Up to and from again 11, 12 months, you may be having expenditure towards salary. That outstanding also will be added with that salary part, and it will be taken in the profit and loss account. Added means the outstanding expenses will be added there. One thing, and at the same time, outstanding expenses, it is a liability and it will be shown in our balance sheet. Okay, it is a liabilities. That is why Schedule 4 only you have to write it. Why it is liability? Now we have to pay it. We have to pay. Likewise, prepare only another example I have paid. You take the example of electricity bill. Electricity bill for the month of March. Generally, we are not paying by 31st March. We are paying it in the first week of April. But that is why it will be treated as outstanding expenses. Though not paid within March, it will be taken in our books of account as outstanding expenses. within 31st March, it will be added to our expenditure, and again same amount will be treated shown in our balance sheet as liability. And the reverse of this is prepaid expenses, something paid in advance, like your vehicle insurance. Insurance for the month of next year. Yeah, maybe from coming March to April, May, we are paid in advance. If we have something paid in advance, means that expenditure is not related to that year. Means we have paid insurance of the next April, May, June period. We have paid next year insurance. The 3 months amount is not related to the current year. That is why that amount will be deducted from the expenditure part. It will be deducted, and that amount of prepaid expenditure will be shown as asset in the balance sheet. Likewise, our accrued income or outstanding income. If outstanding income means income, you are shown as an asset in the balance sheet and added to the concerned income in the profit and loss account. Outstanding income means income due but not received. This is our income, but this income we have not received. And the opposite of that is income received in advance, means unearned income. We have received the amount, but this income we have not received, means it is not related to the March. Up to March it is not related, but we have received that. So how it is treated? Now it will be deducted from the profit and loss account, and as a liability it will be shown in the balance sheet. Then the again come to concept, realization concept. That realization concept says revenue is meant by those amounts which are received by business from sale of goods and services. This principle to determine the time or the particular period in which the revenue is realized. The following basis may be taken for determining the period in which the revenue is realized. That means the moment when you realize the revenue, it will be treated, it will be considered as a revenue. Objectivity concepts means whatever transactions, whatever vouchers we are making in our books of accounts, there should be some evidence. It is not that we have paid, for example, 1,000 for purchasing a particular mouse. That means, first of all, mouse has to be there in the office, and one bill has to be there, and the bill has to be certified, the stock entry has to be there. Then again, one officer has to certify, okay, this item has been received in good condition and recorded in that book, the page number this of that register. So that is the objectivity, means some invoices, some vouchers, some evidences has to be there to prove a particular document. Accrual concept that I have shown you, outstanding, prepaid, these all are accrual concept. Means in this concept, revenue is earned if at all it is received or not, and cost is incurred if at all it is paid or not. Like in this, like our salary expense, salary example I get, though we have not made the payment, but salary expenditure has incurred. This is the accrual concept. In this concept, revenue and cost are accrued, that is recognized as and when they are earned or incurred, irrespective of the fact whether or not money has been received or paid, whether you have received the amount or not, or paid the money or not. But if it is earned or if it is accrued, it has to be recorded. Principle of timeliness means principle of timeliness. According to this principle, the business transaction should be recorded on proper time. Means within a year it has to be recorded, not that it has to be recorded after completion of the accounting period. Then what are the accounting convention? Concept I completed, accounting concept. This is convention. Means the term convention denote circumstances or traditions which guide the accountant while preparing the accounting statement. Concept and conventions are often used interchangeably. The basic difference between is that concept are concerned with maintenance of account, whereas conventions are applicable while preparing the financial statement, which is profit and loss account, trading account, and balance sheet. This is convention. What are the convention? Consistency, full disclosure, conservatism, and materiality. That somehow I have discussed. Consistency means whatever policy, procedure, guidelines you are following, you should follow consistently for year after year. Then only your business transaction, your profitability, your financial position of the business can be compared for with 1 year to another. It has to be consistently followed. Then full disclosure, whatever policy or whatever provisions, guidelines you are following, it has to be disclosed in your books of account. Means it has to be reflected, it has to be maintained, it has to be shown in your books of account. Conservatism principle. Conservatism means every time we have to anticipate some loss, some provision we have to make. Okay, one court case, if one court case is going on, for that we have to put 1 lakh as our contingent liability. Why? Now we may defeat in that court case. So that is why every time we have to make a provision for loss, but at no point of time we will be making provision for profit. That is why conservatism. Then materiality concept means if the transaction, if the item is of material value, it has to be recorded. If it is a very insignificant nature, it can be ignored. If you are procuring pen, paper, pencil, eraser, so many things, it is not like that. You have to you have to make entry for stationery, for pen, for alpine, for gem sleeve. It is not like that. Only a major head under stationery, you have to write all those things. Major head under stationery. Every like pen, pencil, eraser, you don't have to write. This accounting convention of consistency, as I told you, for recording business transaction, same accounting method should be followed every year, so that profit and loss account and balance sheet of the different year should become comparable. Full disclosure, accounting to this, in accounting books of financial statement, all information should be presented fairly, so that different parties interested in the business may obtain complete knowledge of accounts. Then conservative principle, what I told you, according to this principle, the anticipated losses should be arranged in the books of accounts, but all unrealized gains should be ignored. The contingent profit of business are recorded only when they are realized. That is why on this, if you are following, when we are following this convention of conservatism, so we are valuing the closing stock on the basis of cost price or market price, whichever is less. We are charging depreciation. We are making provision for depreciation of fixed assets. We are making provision for depreciation on bad and doubtful debts. We are making provision for disputes in the court against the firm pending judgment. So that is because of this conservatism prudence. Then convention of materiality, as I told you. Then what is the significance of accounting principle? To face competition. If you are following a particular principle, we can face competition. Similar type of business, similar type of enterprises are there. We can compete, very well compete with them. Competitive study of the result of the different years means the results of one particular year can be compared with a next year if you are following a particular accounting principle. And to depict true financial position of the firm, if you are following a correct accounting principle, then to make the information meaningful, and whatever accounting information we are providing, all the information will be meaningful and comparative if we follow certain basic accounting principle. Then what is the limitations of this gap? Now, use of alternative policy and practices. There are so many policies, so many guidelines, so many procedures, so many rules. So this is the one strongest limitation of the gap. Adherence to the historical accounting, as I told you, historical accounting, we are making the entry of a particular laptop at a cost of 90,000. If at all the market value of that laptop is 1,50,000, we are following historical cost. That is why we are bound, we are forced to write only 90,000, not 1,50,000, though the market value is 1,50,000. Then use of personal judgment. I am accounts officer, you are accounts officer, he is accounts officer. Sometimes the judgment of the accounts officer also differs. while charging depreciation, sometimes we also think, no, we should charge depreciation at the rate of 10%, means the value of the life will be adjusted within 10 years. Somebody may tell, no, we should charge depreciation at the rate of 20%, because the value of that assets will be expired within 5 years. So it is also some personal judgment take place, the lack of index. So there is no specific index for the gap. It is, again, as I told, is man-made. It differs from person to person based on the judgment, based on the experience. It is the index. That is why there is no index. There is no proper index in the gap. So this is all about my presentation on gap. If anyone is having any doubt. This is the what I told, very fundamental things, and on this basis, other accounting like your trading account, profit and loss account, receipt and payment account, income and expenditure account, all will be there. Okay, so all this will be based on this concept convention only.